So let's talk about this valuation bubble brouhaha that's happening. In 2008, Sequoia published this PowerPoint, this infamous PowerPoint presentation, RIP Good Times. So I'm going to ask Alfred, do you think the good times are back?
I think good times. Things go in cycles. Business cycles happen. I think we're in an interesting cycle right now. You and I talked backstage about some of the high-flying stocks coming down and having bad days yesterday. I don't really look at the stock market from day to day, but the Nasdaq is still up from last year.
Some people are saying tech is way overvalued. What do you think about that?
I think there are pockets of tech that are way overvalued. I think a lot of it has contracted somewhat in the last couple of months. But I think as a general statement, well, and specifically my own position on this, I think that it's probably tech is undervalued and the S&P is overvalued.
I don't know if I'd say too much money. I think it's definitely a wonderful time to be an entrepreneur, especially an entrepreneur who has established some semblance of traction. So certainly when we talk to our portfolio companies, if you're capable of tapping the capital markets, now's a great time to do it. I'm not loathing any type of correction if that's what you're asking.
You can grow users really quickly. You can grow top line really quickly. You can't go profits that as quick generally. And I think it takes a lot of time to build companies now. And I think that the cost of building companies, actually the cost of starting companies is low, but the cost of building these breakout companies, the costs are massive.
Yeah.
So they have to raise hundreds of millions of dollars. The costs are really high. Now, there are definitely exceptions, and I love when an exception comes along like WhatsApp, when you look at that cost structure and you're like, oh my God, that's obviously the holy grail.
And I said this in my post yesterday, I don't think Square and Box are in real trouble. I think they're going to have to navigate their way out of that. They may have to do another financing, and that financing, like Facebook's DST financing, might be at a lower price than the last round, or they might have to cut back their spending and make their money last longer. I mean, those two companies, I think, are going to be fine, but I think in general, the public market valuations got too high, and then that went down into the private market, and the private market valuations got too high, and now the public market valuations are correcting, and now there's a bunch of companies that raise money at really high valuations in the private markets, and they're going to have to deal with that.
These are companies that are generating real revenue and growing and adding value in this world. I'm much more optimistic. Having said that, our view is we just kind of have a steady approach to the pace. So we are not like blowing out a fund in 11 months. I think, in the 9 years we've been in business, our pace is basically like 2 investments per general partner per year in good times and in bad.
We went through somewhat of a drought during the financial crisis where there was no IPO of tech companies. Everything was kind of repressed in terms of valuations. And now we're seeing the markets open up, some really great companies come out, some doing really well, some not doing that well. So I think we're coming back to some sort of normal period where tech companies are actually valued. Most investors in the public market would like to own pure play tech companies, and for a long time, you didn't see that.
As valuations have moved up a lot, the amount that we get diluted post our initial investment has gone down. And so we thought it was fair that we, given that there's like a specific percent we're trying to own at exit, moved our terms down a little bit too.
And I remember him saying, man, the window is going to shut and the valuations are going to come way down. And as a guy who just closes A, I'm like, how the fuck can that possibly matter? Like what? Like I've got like 30 people in my company. How can public market valuations possibly be relevant to me? Because it's going to be so many years until it comes out. And now as an investor, what I realize is that, as you're justifying things, you're trying to talk about how to get to be billion or multi-billion dollar companies, you're trying to figure out ways to justify that, and a lot of times it's the public market comps, because they're the only things that are really public, and this is 40 times revenue or 30 times revenue or earnings or whatever. And so I think that it takes a little while to work through the system. My sense is that the tech sector of NASDAQ is going to be a little choppy for a while. Like for long term, it's clearly up and to the right as far as you can see, but it's going to be choppy for a while.
Money accrues to the winners right now, and in the internet winner doesn't take all, but it takes more than most now. And that's why you have all the dollars chasing number one and number two. The only reason you would back a number two is because you think there's some way that they can become number one. But number three, number four, number five tends to be irrelevant.
Gigantic tech companies like Apple seem not overvalued to me. I think some of the software as a services businesses got pretty overvalued and maybe still are. I think some of the early stage stuff got way overvalued, but that's come down a lot. And again, I think like all of the growth in the economy right now is in tech. And the only thing that is working really well is tech.